What if I told you that the feeling of running on a treadmill, always pushing hard but never getting anywhere, isn't your fault, but a problem with the instruction manual you were given? That manual about money your parents taught you, that school reinforced, and that your bank manager loves for you to follow. What if that manual was actually written by those who profit most from your stagnation? Let's tear up that manual today, because the truth is, 99% of people follow financial rules that guarantee they'll never get rich. And the remaining 1%? They're not smarter, they just read the correct manual. The first chapter of the wrong manual is called "Keep Your Money in a Savings Account. It's Safe." This is perhaps the most comfortable and destructive lie we've ever been told. Think of your savings account not as a vault, but as a bucket of ice on a sunny day. You put your hard-earned money in there. You look at your statement and see a slightly larger number each month, a few cents in interest. It seems like it's growing, right? Wrong. The sun, in this case, is inflation. As your ice slowly melts, turning into water, your purchasing power evaporates. Let's look at the facts. In the last 10 years, official inflation in the U.S. has averaged around 3 to 4% annually, sometimes higher. Savings accounts, during many of these years, yielded less than that. What does this mean in practice? It means that if you left $100 in a savings account a decade ago, today, even though the statement shows a higher value, the real purchasing power of that money is less. You can buy fewer things with it. Your money didn't grow, it shrank. You weren't saving, you were losing. The security of a savings account is the certainty of becoming poorer each year, but in such a slow and silent way that you don't even notice. It's like being cooked on a low heat. And this leads us to the second chapter of the flawed manual: avoid risks at all costs. We've been taught to dread the word investment. We associate it with risk, catastrophic losses, the image of an uncle who lost everything in the stock market. But here's the irony: not taking risks is the biggest risk of all. Standing still in a savings account, as we've seen, is a guaranteed loss. The mindset sold to us is one of fear. What if I lose money? But the mindset of those who prosper is different. What if I make money? The wealthy don't avoid risks, they manage risks. Think about crossing the street. It's a risky activity. You could get hit by a car. Do you stop crossing the street because of that? No. You learn to look both ways, wait for the signal, use the crosswalk. You manage the risk to get to the other side, where opportunities are. In the financial world, diversification is your crosswalk. Having different types of investments is your looking both ways. Avoiding financial risk is like deciding to live forever on an isolated island for fear of crossing the bridge. You're safe, but you'll never get anywhere. So, what do the rich do so differently? They don't follow the manual you were given. They wrote their own manual. And the first and most important rule is, money is a terrible master, but an excellent employee. Most of us are taught to work for money. We trade our time, our energy, our lives for a paycheck. The rich learn to make money work for them. They buy assets. What's an asset? Forget the complicated language. An asset is anything that puts money in your pocket, even when you're sleeping. A liability is anything that takes money out of your pocket. Simple as that. For most people, their primary home is their biggest dream and their biggest asset. For the rich's manual, if it only generates expenses like property taxes, HOA fees, and maintenance, it's a liability. An apartment you rent out to someone else? That's an asset. It pays you a salary every month. Imagine that every dollar you have is a tiny employee. If you leave it in a savings account, it's like paying it a starvation wage to sit around all day, losing strength. If you buy shares in a profitable company, you're putting your employee to work in that company, and it brings you a share of the profits. If you buy a share of a real estate investment trust, REIT, your employee is working as a landlord, paying you rent every month. The question is, are your employees working for you, or are they on permanent vacation at your expense? This leads us to a fundamental question. If the rules we were taught are so bad, who benefits from them? Who wrote this manual? The answer is simple: banks and the government. They are the biggest beneficiaries of your lack of financial education. Let's talk about banks. How do you think they make so much money? A crucial part of their business model depends on your safe money in savings accounts. They take your money, for which they pay you a pittance in interest, and lend it to other people at absurdly higher interest rates. Car loans, overdrafts, credit card interest. They use your money to get rich. You give them the raw material for almost nothing, and they transform it into a luxury product they sell to others. You are the base of the pyramid that sustains their profitability. And the government? The government has a powerful and invisible ally: inflation. When a government spends more than it collects, it needs to finance that debt. One way to do that is by printing more money. But when there's more money in circulation for the same amount of goods and services, what happens to prices? They go up. That's inflation. Inflation is, in practice, a hidden tax. It doesn't appear on your paycheck, but it erodes the purchasing power of your salary, your savings, your 401k. Keeping your money idle allows this invisible tax to slowly impoverish you. The system is a perfect machine. The government encourages you to trust savings accounts. Banks profit from your idle money. Inflation, managed by the government, diminishes the real value of your assets. It's a vicious cycle where the public's lack of knowledge is the fuel that keeps the machine running. They don't want you to learn to invest, to protect your money from inflation, to make your money work. A citizen who depends on the system is a citizen much easier to control. So, how do we break this cycle? How do we start playing by the right manual? You don't need a PhD in economics. The first step isn't about money, it's about mindset. It's about changing the question, where do I keep my money safe, to how do I make my money grow and work for me? The first real investment you need to make isn't in stocks, funds, or real estate. It's in knowledge. Understanding what the federal funds rate is, what the prime rate is, what inflation means. Not to become an expert, but to understand the language of the game. Knowing these basic rules is like learning to read traffic signs before you start driving. Ignoring them is like driving blindfolded, hoping not to crash. The second step is to start small, but start now. The greatest ally for those who invest isn't the amount of money, but time. It's the power of compound interest. Albert Einstein supposedly called compound interest the eighth wonder of the world. It's the snowball effect. A small snowball, if it rolls long enough, becomes an avalanche. $100 invested per month might seem small, but over 30 years with a reasonable return, it transforms into hundreds of thousands of dollars. The secret isn't the amount, it's consistency. Think about it. Most people plan their lives around work. I'll work 40 years to retire on Social Security. Those who play the other game plan their work around their investments. I'll work to generate capital, which I'll invest so my assets pay my bills and give me freedom. The goal isn't to stop working, it's to have the option to choose. Freedom isn't having rivers of money, it's not being a slave to the lack of it. So, what's the first practical step today after watching this video? Open an account with a brokerage firm. It's free, online, and takes minutes. The simple act of doing this already psychologically puts you on a new playing field. Then, instead of putting your next $50 or $100 into a savings account, transfer it to the brokerage and buy a treasury bill, T-bill, or a money market fund. It's as safe as a savings account, but typically yields more and familiarizes you with the environment where things truly happen. This is your turning point. It's your decision to stop playing a game of defense where you inevitably lose and start playing an offensive game where you have a chance to win. It's not about getting rich overnight. That doesn't exist. It's about stopping the slow process of becoming poorer, which is what the current system is designed to do to you. What you learned about money wasn't just wrong, it was intentionally inverted to benefit others. The security of a savings account is an illusion. Avoiding risks is a trap. Blindly trusting your bank is handing over the keys to your financial future to those who care least about it. The rich know this. They don't accumulate money, they accumulate assets. They don't run from risk, they manage it. They don't let money sleep, they put it to work 24 hours a day. The question that opened this video was, what if everything you learned about money was wrong? The question I want to leave you with now is, since you now know that it was, what are you going to do about it? Your journey to rewrite your own financial manual begins today. And the first chapter is about building your army of employees. But how do you choose the first soldiers? What are the safest and simplest assets for someone starting from scratch? That is the topic of our next meeting.